Welcome once again to our commerce classroom. In this session, we will discuss about leverage analysis. All of you know that debt and equity are major components of capital structure. Whenever there is change in debt and equity in our capital structure, there is an impact on shareholders' risk and return. The effect on shareholders' risk and return as a result of change in debt equity mix is leverage. I repeat, the effect on shareholders' risk and return as a result of change in debt equity mix is leverage. There are three types of leverages: financial leverage, operating leverage, and combined leverage. First type of leverage, financial leverage. Financial leverage arises when a firm employs a combination of equity capital and fixed charge securities. We know debt and preference share capital, they are fixed charge securities. Using fixed cost capital with equity capital is known as financial leverage. I repeat, using fixed cost capital like debt and preference share capital along with equity share capital is known as financial leverage or capital leverage. Our capital leverage or financial leverage may be favorable or unfavorable. If our financial leverage is favorable, we will call it as trading on equity. The formula to find out financial leverage is operating profit divided by EBT. Operating profit, earning before interest and tax. EBT is equal to earning before interest and tax minus interest and preference dividend. Then degree of financial leverage. Degree of financial leverage. Degree of financial leverage measures the impact of change in earning before interest and tax on change in earning per share. This formula, degree of financial leverage is equal to percentage change in earning per share divided by percentage change in earning before interest and tax. If our financial leverage is more than 1, that means we are enjoying higher financial leverage. But at the time of increasing financial leverage, our risk will also be higher. The risk of equity shareholders will also be higher. Second type of leverage is operating leverage. Leverage associated with asset acquisition or investment activities is referred to as operating leverage. I repeat, leverage associated with asset acquisition and investment activities are called operating leverage. Then operating leverage refers to the ability to use fixed operating costs to magnify the effect of changes in sales on its operating profit, earning before interest and tax, and resulting more proportionate change in earning before interest and tax with the changes in sales volume. Operating leverage is equal to contribution divided by earning before interest and tax. If our contribution is greater than our fixed cost, our operating leverage is favorable. Then degree of operating leverage. Degree of operating leverage is equal to percentage change in earning before interest and tax divided by percentage change in sales. Then we discuss about combined leverage. We know combined leverage is equal to financial leverage into operating leverage. So we multiply the formulas of financial leverage and operating leverage to get combined leverage. That is equal to, we know, earning before interest and tax divided by earning before tax. That is what the formula of our financial leverage. And then contribution divided by earning before interest and tax. That is what the formula of our operating leverage. By combining these two formulas, we get contribution divided by earning before tax. So Combined leverage is equal to contribution divided by earning before tax. Then degree of combined leverage. Degree of combined leverage is equal to percentage change in earning per share divided by percentage change in sales. I repeat, degree of combined leverage is equal to percentage change in earning per share divided by percentage change in sales. I think the topic explained here is clear for all of you. We will meet again. Till then, goodbye.